If you have $1,000 in your account right now and you don't know how to invest it, you are in the right place at the right time. And know that this is not a coincidence, but a sign of destiny. I will give you the detailed guide on how to invest your first $1,000 and multiply it infinitely. No fluff, no gimmicks, just actionable steps to turn that first $1,000 into the foundation of your financial future. For convenience, I have divided everything into 13 steps so that you can remember them more easily. I can already tell you that step number 4 and number 12 are the fundamental ones that can change your life forever. Let's start. Step 1. Get your financial foundation in order. Before you even think about investing, you need to set the stage. This isn't the glamorous part of growing your money, but it's the most critical. Pay off high-interest debt. If you're carrying credit card debt at 18 to 25% interest, paying it off is your best investment. Think of it this way. Every dollar you pay toward that debt is a guaranteed return of that interest rate. No stock, bond, or real estate investment can promise that level of security. Build an emergency fund. Life happens. Unexpected car repairs, medical bills, or job losses. Before you invest, make sure you have at least 3 to 6 months of living expenses saved in a high-yield savings account. This ensures you won't need to sell your investments at a loss if an emergency arises. Budget wisely. Make a plan for how much of your future income you can allocate to investing each month. A good rule of thumb is 10 to 20% of your paycheck. Step 2. Understand your risk appetite. Investing is a balance between risk and reward. The younger you are, the more risk you can usually afford to take because you have time to recover from market downturns. But not everyone has the same tolerance for risk. Here it is a list of low-risk options for cautious investors: high-yield savings accounts, government bonds or treasury bills, dividend-paying stocks with a history of stability, and here it is a list of high-risk, high-reward options for aggressive investors, individual stocks in growth sectors like AI or renewable energy, cryptocurrencies like Bitcoin or Ethereum, crowdfunded startups or speculative investments. A quick test. If the idea of seeing your $1,000 drop to $800 gives you sleepless nights, stick with low-risk options. If you're okay with short-term losses for long-term gains, explore higher-risk investments. Step 3. Invest in index funds. Index funds are the simplest, most beginner-friendly way to invest. They offer instant diversification by spreading your money across hundreds of companies. The most popular option? The S&P 500 Index Fund, which tracks the 500 largest companies in the U.S. Why index funds are great? Low fees. Unlike actively managed funds, index funds have minimal management costs. Proven performance. Historically, the S&P 500 has delivered an average annual return of around 10%. Simplicity. You don't need to spend hours researching individual stocks. To start, it's very simple. Open an account with a brokerage like Fidelity, Robinhood, or Vanguard. Search for funds like VOO, SPI, or QQQ. Invest your $1,000 and set up automatic monthly contributions. Pro tip: use dollar cost averaging. Instead of investing your $1,000 all at once, spread it out over several months. This reduces the risk of buying at a market peak. Step 4. Subscribe to this channel. Now. Wait, don't skip this point. I'll explain why it is one of the fundamental steps. By subscribing to the channel and leaving a like, you will ensure that the YouTube algorithm recommends more and more videos similar to this one. And in this way, you will have more and more skills to become financially free. You can also decide to skip this point, but know that every small action will bring big results. If you decide to listen to me, subscribe now. Remember, rich people do everything right away. Step 5. Buy fractional shares. Gone are the days when you needed thousands of dollars to buy a share of Amazon or Tesla. With fractional shares, you can invest as little as $1 in any stock, no matter the price per share. But why fractional shares are a game changer? They allow you to diversify your portfolio, even with small amounts. You can own a piece of high-value companies without needing a huge upfront investment. Platforms like Robinhood, M1 Finance, and Fidelity offer fractional investing. For example, with $1,000, you could own a portion of Amazon, Tesla, Apple, and Google instead of putting all your money into one stock. Step 6. Build a dividend portfolio. Dividend stocks pay you regularly just for owning them, making them a fantastic option for generating passive income. These payouts can be reinvested to compound your returns over time. If your question is, what to look for in a dividend stock? Here are some tips. Dividend yield. The annual payout as a percentage of the stock price. A yield of 2 to 5% is generally solid. Payout ratio. This shows what percentage of earnings the company distributes as dividends. A ratio below 70% is preferable. Dividend growth. Companies that consistently increase their dividends over time, like Johnson & Johnson or Coca-Cola, are excellent choices. Imagine buying $1,000 worth of stocks in a dividend fund like VYM, Vanguard High Dividend Yield ETF. With an average yield of 3%, you'd earn $30 in passive income annually, just for holding onto your shares. Step 7. Invest in real estate without owning property. You don't need hundreds of thousands of dollars for real estate investing anymore. Crowdfunding platforms like Fundrise and Realty Mogul allow you to invest in real estate projects with as little as $500. I'll briefly explain how it works. Your money is pooled with other investors to fund properties like apartment complexes or commercial buildings. You earn returns through rental income and property appreciation. If you prefer liquidity, consider REITs, real estate investment trusts. These are companies that own income-generating real estate, and you can buy shares just like stocks. VNQ, Vanguard Real Estate ETF, is a popular choice. Step 8. Take advantage of high-interest accounts. While the returns are modest, high-yield savings accounts and certificates of deposit, CDs, are reliable options for those who want zero risk. With interest rates on the rise, some accounts now offer over 4% APY. For example, a $1,000 deposit earning 4% APY grows to $1,219 in 5 years. This won't make you rich, but it's a safe place to park your emergency fund while earning a bit more than traditional savings accounts. Step 9. Invest in yourself. This might be the most underrated investment strategy. Your skills, knowledge, and health have the highest return on investment. And if you're wondering how I can invest in myself, here are some tips. But if you also need others, write to me without problems in the comments, and I will answer you immediately. Take an online course in coding, digital marketing, or design. Attend a seminar on personal finance or entrepreneurship. Buy books that teach you about investing, negotiation, or productivity. A creative example instead is to think of your mind as a stock with infinite growth potential. The more you invest in it, the higher its market value. Step 10. Diversify with emerging trends. 2025 is shaping up to be a year of innovation, and investing in future-forward sectors can pay off handsomely. The top sectors to watch right now are AI and automation. Companies like NVIDIA or Palantir are leading the charge. Renewable energy, ETFs like ICLN, iShares Global Clean Energy ETF, focus on solar, wind, and green energy. Blockchain. Even if you're skeptical about cryptocurrencies, blockchain technology has transformative potential. Allocating a small portion of your $1,000 to these trends can diversify your portfolio while positioning you for long-term gains. Step 11. Automate everything. Automation ensures consistency and removes the temptation to spend money meant for investing. Use apps like Acorns or Betterment to round up your purchases and invest the spare change. Over time, those pennies add up. For example, if you spend $3.75 on coffee, these apps round up to $4 and invest the 0.25s. Doing this daily can add hundreds to your portfolio each year without you noticing. Step 12. Learn the psychology of investing. Investing isn't just about numbers, it's about managing your emotions. The stock market will rise and fall, but the biggest mistake you can make is selling out of fear. There are 3 key principles, and they are: think long-term. Time in the market beats timing the market. Ignore. Noise. Daily news can make markets look more volatile than they are. Stay consistent. Regular investments, even during downturns, yield the best results. Step 13. Reinvest your returns. Every dollar your investments earn should go straight back into your portfolio. This is the magic of compound interest, where your money grows exponentially over time. Here it is an example. If you invest $1,000 and earn a 10% return annually, reinvesting your earnings means that in 10 years, you'll have $2,593. Double that timeline, and it becomes $6,727. In conclusion, investing your first $1,000 is more than just a financial decision. It's a commitment to your future. The steps we've outlined are designed to grow that money into a foundation for financial freedom. Whether you choose index funds, real estate, or self-investment, the key is to start now. Waiting won't make you richer, action will. Take that first step today and watch how far it takes you. If you found this guide helpful, share it with someone else who could use it. And absolutely don't forget step number 4. See you soon.